Good morning. Welcome to today's webinar, Managing Risks and Seeking Opportunities for Pension Funds. It's good to see so many of you here with us today, and for a change, I can actually see the attendees. My name is Rachel Pine, and I look after content for the PLSA's events and training. We're delighted to have our education partner on fiduciary management, Russell Investments, here with us today to talk about the lessons they learned after the global financial crisis of 2008 and how they can apply them to the current environment. Russell is a global investment solutions provider with a particular focus on fiduciary management. They have more than 70 professionals working in their fiduciary management team, and we have 3 of them here with us today: Sasha Mandich, Alex McClelland, and David Morton. I'm going to mute myself now and turn this over to Sasha, Alex, and David.
Thank you very much, Rachel, and good morning, everyone. I hope you're well, and thank you for joining us. Today, we're talking pension fund strategy. What we're looking to do is look back on 2008, the last big financial crisis, and then compare and contrast it with what happened over the last 6 months. And the goal really is to come up with a few takeaways for what schemes can do now to improve and strengthen their funding position. Now, as Rachel explained, it's a new format. We do really want to make it interactive. Hopefully raise the hand works. We also don't have all the answers. So many of you in the audience run very sophisticated strategies, have a lot of experience. So please do feel free to share your insights with the rest of the audience. So let's kick it off. Maybe Alex, if we can start with you. Could you please cover one feature of this year's crisis that you feel is very similar to what we experienced during the GFC?
Sure. Thanks, Sasha, and morning, everybody. So to get the discussions flowing, I think that one of the key things that really struck me towards the end of March was that for many investors, their so-called diversified portfolios didn't quite cut the mustard and do the job that they were supposed to do when things got really messy. So I don't intend to dwell on this point for too long, as I'm sure that everyone on this call is more than well aware by now, but the market conditions over the course of late February and March were pretty tough out there. So as an example, over the 2 weeks ending March the 20th, the S&P fell 22.4%, and the Barclays Global Ag Index lost 5.5%, which was its worst 2-week stretch since 1980. And if you compare the movement of nearly all asset classes to what happened during the global financial crisis, they're actually strikingly similar, just almost as if it were a textbook exercise. And there were, of course, some things that did help over the quarter as a whole, so gold and government bonds being 2 of those. However, this wasn't without volatility in these areas either, with a period in March where both of these asset classes were also in free fall almost. So during the global financial crisis, gold and government bonds rallied in the long term as well and helped provide protection. But again, there were still pockets of time of severe market stress that they were hurt too. And I think a good example of this was in October 2008. So sort of at the time when equities were bouncing along the bottom. And in this period, we saw gold fall in value by 20% in a 1-week stretch. Gilts didn't help that much that week either, and they also fell in value, but at least in the case of gilts, it was constrained, I think, to a fall of around 0.5% over the week.
Yeah, thanks, Alex. Now, but most investors obviously now will have fairly well-diversified portfolios. Is there any reason why we still saw the funding level drops that we did?
I think that there are a couple of things at play here, but I'll answer this by covering off that short but sharp free fall period in mid-March when, quite frankly, no asset class, except perhaps for equity protection type strategies, seemed to be having a good time. So as investors tried to rebalance their portfolios to cover losses on their equity books or to release capital to cover some of the collateral calls that they were seeing on their leveraged positions, they ended up selling just about anything they could. This led to a real lack of supply in many assets. And those investors actually ended up selling the more liquid, lower risk assets they held, hence the fall in value that we saw of high quality corporate bonds and even government bonds as well. And this looked very similar to what happened throughout the GFC, with credit markets most adversely affected there. And this type of situation creates the perfect storm, so to speak, for institutional investors who have holdings in leveraged fixed income investments to track the movements in their liabilities alongside equities to help outperform those liabilities. And they saw what were really quite sizable collateral calls from some of their underlying LDI providers, which needed to be covered by selling some of their return-seeking assets, such as equities, just as they had eroded in value. And for those holding the riskier assets, many of them got a bit of a rude shock when these portfolios were forced to impose large sell spreads as their underlying bond and loan holdings became illiquid.
Thanks, Alex. Now, obviously, we've seen the recovery. What brought the step to, what brought to a stop the kind of the market rout?
So I'd say that's another similarity with the global financial crisis, which was really that the central bank sort of rushed to the rescue. And if we look back this time to July 2012, it was then that the former ECB president, Mario Draghi, first uttered those three little words of "whatever it takes." And I'm going to share my screen now with you all. And if you're all now able to see my screen, I particularly enjoyed this graphic that The Economist produced, which clearly shows the echo in the media and the correlation between this media buzz and impact on the financial markets of the now infamous statement. So if we first look on the left of the chart, in 2012, the yield on government bonds had been edging higher through July, but as soon as Draghi mentioned that the central bank were prepared to do whatever it takes, and the press then were able to pick up on this, the words in themselves were enough to change the direction, and we see them actually then start to fall. And similarly, if we look on the right-hand side of the chart, in March 2020, the impact of the same statement in the UK led this time to even greater reverberations in the press. And this was enough to calm UK equities before any central bank intervention actually even occurred. Another similarity is that despite the very different nature of the underlying causes of the financial turmoil in 2007 and 2020, this kind of whatever it takes approach has actually led international central banks to respond with similar tools. So I suppose if we think about what are these tools, so we've seen policy rate cuts. So in both occasions, despite the fact that they're moving from very different starting points, we've seen asset purchase programs, which since the global financial crisis have become a bit of a staple in the arsenal of central banks, especially with short-term rates now near their zero lower bound. They've introduced special lending facilities, and some of these that we saw during the global financial crisis have actually been resurrected. And the final one that I would raise is we've seen some modified financial regulations, such as relaxing capital requirements for banks. So without stealing Dave's thunder on this one completely, as I know that you've been asking me some questions around similarities, Sasha, it is important to note that whilst these tools are the same, the speed at which they were implemented is drastically different. So what took central banks almost years to sort out in the global financial crisis was rolled out in a matter of days this time around.
Thanks, Alex. Could I just check at this point if there are Any questions or comments before we continue? I haven't seen any raised hands yet, but I just wanted to check if anyone wants to jump in. Probably not. We are still warming up, so let's keep going. Thanks, Alex. You kind of covered the similarities. Dave, if we can turn to sort of what's different, especially we start with markets. What's different in terms of the market behavior this time around compared to the GFC?
Yeah, thanks, Sasha, and good morning, everybody. I guess leading on from what Alex was just saying, central banks and governments used the same QE tonic that appeared to remedy the global economy throughout the GFC. The main difference this time is the speed that they were able or felt comfortable to find that QE bottle from the medicine cabinet and prescribe themselves a much bigger dose. So I think this is best shown. I'll just share my screen with you all. So the chart on screen looks at the drawdown and subsequent recovery in equity markets from the GFC, which is the green line, and the COVID sell-off, which is the pink line. Perhaps not surprisingly, that under both risk-off events, markets bottoming coincided with the announcement of QE. It's easy to forget now, looking back, that QE on this sort of scale was a relatively untested medicine back in 2008, and it took much longer for the coordinated QE effort from central banks. In fact, the first dosage, which was in November 2008, didn't work, so the Fed had to go in again in March 2009. Together, these two bouts of asset purchasing were called QE1. This time around, central banks moved quicker and more decisively, and by that I mean central banks have taken days rather than months to pump in the amount of support that was required in the immediate response to the GFC. It's really this that's drove the recovery that we've seen over the last 3 months in the pink line, and the recovery that we saw from the real depths of the crisis following the GFC. I guess the second thing, if I just flick on to the next slide, the other main difference this time around is the starting point for yields going into this crisis. So this chart shows the synchronization in yields globally over recent history that we all know too well. You can see that before the summer of 2016, the green and the pink lines were pretty well correlated. These are UK and US long-dated yields. We all know what happened in the summer of 2016, and you can see the impact on the UK gilt market following the referendum, and that was the step down in yields, so the step down in the lighter green line. This is really important, particularly if you're a believer in what's sometimes known as the zero lower bound or some sort of natural floor to interest rates. So if yields are lower, then that should mean there is less room for yields to fall going forwards. We feel that this has quite big implications to how government bonds behave going into crises going forward, and the level of protection that they provide. So to show this, the COVID crisis actually provides quite an interesting case study. The table on the right-hand side shows the changes in long-dated yields over Q1 of this year, and suggests that countries where interest rates are higher have felt greater downward pressure on yields. So US being the obvious example. Long-dated yields are down 1% over Q1. To a lesser extent, UK, where yields are down 0.5%. Japan, of course, have had a near zero long-term interest rates for years. So their behaviour has been particularly interesting during the COVID crisis, where yields have actually marginally risen and now are higher than where they were at the start of the year. I think the next question is, what does all this mean for investment strategy and portfolio construction? Now, I'm not bold enough to try to make any sort of prediction in the direction of UK yields going forward, but I think what is fair to say is that the lower yields are, the less extreme any fall will be. And actually what you might find is that those low or near zero yielding government bonds provide little or no downside protection during the next risk-off event.
Dave, just to clarify, the chart you showed earlier, that was sort of nominal bond yields, right?
Yes.
So
Yes.
on a real basis, a lot of those yields are already negative. So just to explain your point about zero bound, are you saying that nominal rates can never go below zero, but real rates are obviously already far below in some countries?
Yeah. So the sort of central theory that's doing the rounds over the last number of years is this zero lower bound theory, where central banks are limited in terms of how low they can force their nominal interest rates. I sort of stuttered when I said the zero lower bound, purely because I don't actually believe it is zero, but I do believe there is a natural bound to interest rates. If you can think about where we all put our money and deposit our money in banks, as soon as those interest rates are at zero, we'll probably still deposit our money in banks for the sheer convenience of it all. But if they go materially below zero, we will find more creative ways for us all to store our cash, whether that's under the mattress or safes or safety deposit boxes. But what I'm trying to say is, we as individuals change our behavior when those interest rates start going below zero. So it's really or materially below zero. So that's where the lower bound comes in.
No, thanks for clarifying, Dave. I still am not seeing a raised hands. I will not pick on people, I promise. So we'll keep going, and hopefully we'll get a few questions. Again, the chat box works equally well. If anyone has a question, I'll try and pick it up. Okay, we've sort of covered the past, what's similar, what's different. Dave, if we turn to the future now and do some effectively takeaways, especially given your comments about yields, what can pension schemes do now? What would be the first, what should be maybe almost first on their priority list, in your opinion?
Yeah, sure. So, well, firstly, from my perspective, it's to tighten up on any unintended risk exposures that might exist. So my personal view is that liability risk is unrewarded. We've seen consultants and managers try to add value by tactically going short duration or under hedging pension schemes liability since the GFC. But these sort of active bets, for want of a better word, have been quite foolhardy. They haven't paid off. As such, I'd recommend that pension schemes manage liability risk as much as possible going forward. I can imagine the people on the call will be questioning the benefit of hedging now, particularly after what I was saying earlier about rates now being closer to that lower bound. So although there is some room for UK rates to fall from here, for those that haven't hedged, I can understand, or rather sympathise with, the difficult position that puts schemes in. For trustee boards in this sort of situation, we've been suggesting that trustees try to untangle the two main liability risks that exist in their pension schemes, and that's interest rates and inflation. So yes, interest rates are incredibly low. And yes, you could argue that the level of interest rates rarely have been more expensive than the current levels in history. But inflation protection, on the other hand, is relatively cheap at the moment, even when you reflect the change in the RPI CPI wedge following the ongoing consultation. At the end of March, long-term inflation protection, I should say, was cheap. In fact, you'd have to go right the way back to 2003 to find it cheaper. Although forward-looking inflation has nudged up slightly over the last quarter, it remains relatively low, certainly than it has been in the recent past. So whilst we as a firm see inflation being muted for the next 18 months or so, we do expect inflationary pressures to reappear over the medium term, not least as a result of the huge amount of stimulus that's been pumped into the economy over the last few months.
Thanks, Dave. Okay, we've covered sort of liability risk, if you want to call it. On the growth portfolio side, Alex, the volatility you discussed earlier, I think there's a lot of commentary, is it here to stay? I guess when the markets go up, no one worries about volatility too much. It's sort of like it doesn't matter how volatile it is as long as it's going up. And when it's smooth, it's even better. But we'll probably expect some more volatility to be around. Is it too late to do anything about it, or are the tools pension schemes can use to try and have a smoother ride?
Yeah, no, firstly, I think I'd say it's never too late. So I think with volatility, the first most important step for pension schemes is really to acknowledge its existence. And it's a bit like you said, Sasha, whilst there is very little that we can say with any degree of conviction about the direction of markets from here, I think we can be a little bit more confident in saying that we do think that volatility is here to stick around, at least for a little while into the future. And there are lots of news stories out there at the moment about how the situation is improving. Lots of asset managers and research publications that I've read reviewing their forecasts back to a V rebound in markets. But if you look at things and the data a little bit more closely, I think things are really still quite choppy out there. And in February, volatility, so if we take it as a measure of the VIX level, was hovering around its long-term median at around 17. And in less than a month, it skyrocketed to an all-time high of over 80. Since then, over the last few months, it's kind of been hovering around 30. And although this most recent level seems rather tame compared with its March peak, I think it's important that investors understand that these current readings are around the 90th percentile level for the VIX index. And to really kind of put it into context, a VIX level of 30, so similar to what we have been seeing recently, implies annualized volatility of 30% or daily moves of 1.9% in the market during the next 30 days. So once you have acknowledged its existence, I guess the natural next step is having an investment process in place that's set up to deal with these bouts of volatility, and one that can react dynamically when they do come along. So, I mean, even if it does turn out that volatility is muted for a period of time, having these processes in place will not adversely affect returns, and it helps to ensure that you aren't caught up making any rash decisions if indeed it does flare up again. What we have seen over the last few months is that the most successful pension schemes throughout this episode were those who had those good risk management processes in place, as well as the governance structure to be able to react to the sharpness of the rebound by quickly re-risking. So, I mean, no one can predict the future. I don't have a crystal ball, I wish I did. But what this does involve is reacting to the signals that are coming out from the data that you have been given. And I've got a few examples of what some of these signals may be and how we were able to implement them in client portfolios. So I guess the first one that I'd cover off is that you can look at where you are in the cycle. So a good example of this was that throughout 2019, we were more than well aware that we were entering into the longest bull market in history. And at that point, whilst a global pandemic was perhaps not the risk at the top of anyone's radar, there were many potential geopolitical and other risks out there. So within our client portfolios, we had spent the year incrementally kind of building up defences in the form of government bond exposure, equity protection strategies that we were able to implement in-house, and also adjusting currency towards weightier allocations to the US dollar and Japanese yen, which tend to also display defensive characteristics. Another aspect that we think can help is looking at valuations. So placing an estimate on how cheap or expensive something is. So I've mentioned that we added government bond exposure throughout 2019 for its defensive properties. However, through looking at the valuation, that also helped to ensure that we incorporated how cheap or expensive we viewed some of these different government bonds to be. And this led us towards exposure in areas like the US and Australia, where rates were higher and therefore had further to fall, so to speak, as we went into 2020. And I guess the final point that I'll raise at the minute is that investor sentiment can really tell you quite a lot. And to study this, our strategists look at an array of market surveys and data points. And one of the key indicators that they look at, that I'll pull out as an example now, is what is termed the put-call ratio, which looks at the proportion of bearish investors who are wanting to buy equity protection versus the proportion of the bullish investors who are wanting to buy some upside exposure in the form of call options. And normally this ratio for US equities hovers around 0.6. So for every 10 call options being written, there are 6 put options. However, in early 2020, we saw that this level had actually fallen to below 0.5, which we felt was quite low given where we felt that we were in the cycle. And so we were able to use that opportunity to procure some more protection when the prices were fairly attractive. If you then fast forward to March, we see the ratio jump to nearly 1.3. So at this point, for every 10 call options, there were now 13 put options being written. And this is a real kind of measure of fear in the markets, and sort of helped to demonstrate the real fear that there was amongst investors at that point. And another thing that this indicator shows us is that typically after a big leg down in markets, like we had seen, it usually takes a bit longer than it otherwise would for market confidence to return. But I'd say that pretty interestingly, this time around, if we exclude what we saw last week, we saw this ratio now move back to below its long-term moving average, and actually even below the lower bound, below which for us there is a signal that indicates excessive confidence amongst investors. So over the last week, we've now seen this kind of shoot straight back up. So as I said, it is still pretty choppy out there, and I think that kind of brings me back to what I said at the beginning, in that there's still a lot of volatility around, and we think that things are likely to be a little bit choppy, at least for a while going forward.
Thanks, Alex. I think quite a technical subject for maybe some around put to spread ratios and so on. But bottom line, people, when things are going well, no one wants to buy insurance. And when obviously markets are down, that insurance becomes very expensive. So having almost a disciplined process, whether it's a board or working with a fiduciary manager, but having the governance process to be able to make the call to buy protection when it's more affordable is quite important for a lot of schemes.
Yeah, no, definitely, and I know it isn't the only solution, but it's kind of periods like this where a fiduciary solution can really help, especially for the schemes that may struggle with the governance aspects. Yeah,
absolutely. So we've covered a little bit about like management of risk on the growth side and liabilities. Dave, we mentioned, it's been 12 years since the previous crisis. A lot of schemes have matured in terms of their liability profile and are becoming more cash flow negative. Clearly, that's another risk that now needs to be managed more carefully. Do you want to make a few comments about that?
Yeah, sure. And that, along with the general theme of yields falling over the last few decades, the other general theme in the pension, specifically pension schemes, is, like you say, schemes maturing and becoming more cash flow negative. And we really think that this will inevitably influence behaviour of trustee boards all over the country. So we've seen that where trustee boards focus has a large impact on how trustees construct investment strategies, how they benchmark and assess managers and consultants, and ultimately drives the assets that the pension scheme ends up investing in. So in the 90s and the noughties, trustees were obsessed with diversification across asset classes. So therefore, you had pension schemes that ended up with a diverse set of risk exposures. Over the last, I'd say 10 to 15 years, trustees have been much more focused on risk. So looking at what could impact the deficit, and therefore have ended up with a greater focus on risk management across the balance sheet. So think introduction of LDI, a liability-driven investment. Now trustees will inevitably have to become more focused on, I guess what I'd argue is the ultimate role of a pension scheme, and that's meeting actual benefit obligations as they fall due. So trustees will no longer just look at their pension schemes through the lens of an asset allocation pie chart and a value at risk chart. They'll actually start looking at their investment strategies through a cash flow lens. So that's looking at the size and the timing of the benefits that need to be paid, and trustees will be asking themselves how they expect to fund these benefits going forward. So this will impact the types of assets that pension schemes end up buying over the next decade or two. So going forward, I think we'll see a great demand for assets with contractable cash flows. So think lending to corporations, to governments, and to individuals.
Yeah, cool. And it sounds like there will be more moving parts to handle than maybe in the past. Liabilities, growth portfolio, and I guess to a degree, obviously, more and more the cash flow matching or management overall. And I know you like football, and I know we support sort of rival clubs, although you haven't been competitive for a while. But you're getting back. But I did hear you use a football analogy to try and explain how these different elements interact. I know it's a bit of a public forum, but it's not a bad opportunity to test it again and explain how different elements come together. Okay,
I knew you'd get one snide football comment in there, but if we put football allegiances to one side, I think the analogy you're talking about is how trustees can think about the different types of assets in their portfolio and the roles that each of these assets play to meet the trustees' ultimate objectives. So whenever we engage with trustees, our starting point is always, what problems are they trying to solve? And unsurprisingly, there's common themes across UK defined benefit schemes. So they normally have a return objective. They normally want to manage liability risk. And as I mentioned earlier, trustees are increasingly wanting a plan in place to meet the benefit obligations that they've got to pay. So our solution for this new problem is to construct a portfolio of assets to achieve a particular cash flow profile that mirrors a client's expected benefit payments. So if we look at a football team, your attackers are the part of your team or assets that are taking risks in pursuit of returns to improve the funding level and remove the deficit. These are return-seeking assets, so think equity, property, commodities, return-seeking fixed income. However, there's no point scoring 4 goals if you're going to concede 5. So we must think about the defence. So we must consider what scenarios would cause the funding level to fall. And of course, the main scenario we've seen over the last couple of decades is yields falling. As such, the defence or LDI portfolio is there to protect against that scenario impacting the scheme going forward. And the assets that an LDI portfolio or a matching portfolio will typically hold will be gilts or gilt repos or swaps. However, as trustees become more focused on income, we've seen the need to bolster our midfield. So income generating assets or an income generating portfolio. These assets, in my opinion, and going back to the football analogy, can be seen as a strategy's engine room. So they're responsible for the scheme fulfilling its ultimate purpose, and that's the paying of benefits to members. To pay pensions, we need assets that pay known, regular payments, which have a high likelihood of materialising. These are typically highly rated corporate bonds, low chance of default, and preferably sort of sterling denominated, so you don't get any foreign exchange noise. Importantly though, like all good midfielders, these assets should help out the defence. So in other words, they should behave a bit like the liabilities when interest rates fall, and they should also contribute to the attack. So they should generate a return above gilts. I think we should be absolutely clear that I'm not talking about CDI or cash flow driven investment here in its pure sense, which has received a lot of airtime over the last 5 years. My own personal view is that for the majority of pension schemes, a CDI strategy is not yet appropriate. In any case, I always come back to how certain can we really be of the cash flows that are going to be expected to be paid in 25 years' time, which is sort of what CDI strategy is supposed to do, match all the cash flows going out until the last member leaves the scheme. So I'd argue that shorter term cash flows are less uncertain. And so we tend to focus on meeting or matching near term cash flows, pension obligations. So what do I mean by near term? Well, we're talking sort of 5 years, 10 years, maybe a tiny bit longer, but normally where we end up is we normally try to match all expected cash flows going out of the scheme up to the date when we roughly think that scheme will achieve full funding on a low risk or buyout basis. So we're calling it a sort of bridge to buyout, and it gives the trustees a clear plan. Sound like a politician here, clear plan, but it gives the trustees a plan to pay benefits of how they're going to pay the benefits up to the date that the scheme ultimately buys out. The final thing I would say on this football analogy is that the best football teams in the world, in my opinion, play total football. So I hate to say it, but what makes Liverpool a great team is that the defenders pose a strong attacking threat. Think of the two fullbacks bombing on, and the attackers defend from the front. So the front three all harass the opposition to win the ball high up the pitch. My view, it's exactly the same for a pension scheme strategy. So the growth portfolio must have the flexibility to defend during times of market stress. Alex talked about the importance of equity protection, that sort of thing. It needs to have that flexibility to go into those sorts of asset classes. The matching portfolio can contribute to return and not just match liability risk, so think security selection or curve positioning. But also a fully integrated strategy can do things like flex the leverage used in the matching portfolio to release small amounts of cash when required. And that really complements the cash that's coming from your income portfolio, the midfield assets, as it were. So whilst I talk about 3 separate positions or roles in a total pension scheme portfolio, it's massively important that the portfolio is managed completely holistically and all various elements of the portfolio are pulling together to meet the objectives for pension schemes, which we see as meeting the return target, managing risk, specifically liability risk, and meeting expected cash flows up to the date we expect to ultimately buy out.
Thanks, Dave. Does the new world of having to sort of manage multiple or more risks than ever before, does that have implications on how schemes may be de-risked from here? You know, historically, maybe or simply you go from growth to LDI. Given what's happened to yields, increased hedge ratios, is that process becoming slightly different in how schemes de-risk?
Yeah. So I always see. Interested maybe if there's any views on the call, but from the clients that we work with and we look after, I guess trustees or pension schemes have a priority list or a list of problems that they want to solve. So first and foremost, you as a trustee, you need to generate some return to get rid of your deficit and improve your funding level. You'd like to generate that return with managing risk as much as possible. So you introduce your matching portfolio or your LDI portfolio to reduce some of the liability risk. And historically, pension schemes have had funding level triggers that reduces risks over time, as you say, and that's typically been in practice selling down growth assets when they've outperformed and transferring those growth assets into a matching portfolio such that your assets behave more like your liabilities and you reduce risk. For most of my clients, they've increased the hedge ratio up to 100%. So their assets, for a given change in interest rates, their assets behave like the liabilities. So there's very little liability risk left on the table. So actually, de-risking triggers are becoming less about transferring assets from simply growth to matching, because you've already solved the matching problem, your liability matching problem. And it becomes more about changing the composition of your growth portfolio to invest less in traditional growth assets and more in assets that can perform other roles for you. So we talked about midfield, a midfield portfolio that generates income when you need it. That's only going to become more of a problem for trustees going forward. So therefore it makes sense to, when you're de-risking your portfolio, you're selling out of your traditional growth assets and moving them into types of assets that will solve your problems going forward. And that, as we're talking about, is income now for most pension schemes. So what I'm trying to say is, in practice, we'll see funding level triggers or schemes de-risking, not from growth to gilts anymore. We'll see pension schemes de-risking from growth to highly rated corporate bonds that provide that income that allows you to meet your benefit payments going forward.
Thank you, Dave. Thank you for those who've turned on the videos. I can see a few of you are writing down notes, so it's it's got a nice feedback in a sort of a virtual world. But again, I'll ask maybe one more round for any questions on this point of de-risking. Here we go, Alistair.
Yes, good day. I don't know necessarily the point of de-risking, but it seems to me, from what you've been saying so far, that the only chances of interest rates going up in the next 5-10 years or whatever is if we have inflation. And then, of course, if that occurs, then the structure of our portfolios takes on a whole new meaning. But what are the chances of inflation occurring?
Yeah, do you want me to take that one, Sasha? Yeah, so I think there's plenty of spare capacity in the economy at the moment. You know, you see a lot of people not working and sat on Bournemouth Beach, shall we say, in the press. So there's lots of capacity so the economy can increase without resulting in inflationary pressure, but that only lasts up until a point. And that's why I was saying earlier, or I think I mentioned that our house view is that inflation will stay muted over the next 18 months, maybe. But long term, I think I'd almost go as far as saying inflation is inevitable at some point to feed into the system because of the huge amount of money that's flowed into the economy. And I would also say now more than in any other time in my lifetime, governments are incentivized to let inflation run for that little bit longer. I've seen, seems like on sort of central bank minutes, if you give them a read, that the type of wording that they're using is really softening in terms of inflation management. They're talking about managing average inflation rather than headline inflation at any given point in time. So I think you've got inflationary pressure from the amount of money that's being injected into the system. And you've also got governments which, to be honest, inflation might do them quite a lot of favours, because one way to get rid of the debt that you've got on your books is to inflate your way out of it. So you basically reduce the value of that debt in real terms. So I think inflation will be a prominent feature in all of our lives and pension schemes in particular, not for the next 18 months, but more sort of longer term. Does that answer your question?
Yes, it does. Thank you very much.
I have another, Richard, please go ahead.
Yeah, I'd like to pick up David on the inflation point. I remember probably 10 years ago, one of our trustees said they were very concerned about inflation, and inflation has just gone down and down. Every time I look at the inflation curve, all it does is move that way. But inflation, central banks have a 2% target, but more and more that has not materialized. And on the one hand, I understand the threat that inflation might pose to your assets and to the scheme if you're not careful. On the other hand, I see no indication that inflation is a problem or like to be a problem. And the fact is, if you keep saying it, eventually you'll be right, but it might be 20 years before you're right. You will be right at some point. But I have to say, I don't see inflation as being an issue for some time to come. Do you want to comment, David?
Yeah, I'd say that's fair. I think I'd agree with you that inflation, over the next couple of years isn't. I can't see how inflation will be a problem. The next one thing COVID has shown us is things can happen that you don't necessarily plan for, or you can't see coming. And so I'm a big fan of hedging liability risk, both interest rates and inflation risks. And I agree with you, looking back, inflation has stayed, not just actual inflation has stayed quite muted, but also forward-looking inflation, we're talking 30 years out, has stayed relatively stable and quite muted. But what I would say is inflation is not an expensive risk to hedge at the moment. So whilst I might be wrong and inflation won't be a problem, it's also not a bad time to buy that inflation protection, just take inflation risk off the table if it's relatively cheap to hedge.
I agree with you. As a scheme, we're 100% hedged on inflation and 80% hedged on interest rates through LDI. So I agree with that, and it's cheap and easy to do. But as a risk, it has not materialised so far.
Yes, agreed. I can agree with that. Of course, the problem is for pension schemes is you're looking out so far, aren't you? So we're not talking about inflation over the next 5 years. What really hurts you is inflation over the next 20 years and 30 years. And it's incredibly hard to predict. So I'm 100% with you that you fully hedge your inflation risk, as you say. And sometimes, as sort of Sasha and Alex were talking about earlier, sometimes it makes sense to hedge by protection when you don't almost think you might need it because it's relatively cheap if other people share that opinion. So I think it's a very pragmatic thing to do, to just, pension schemes have enough risks going on. So if one's cheap to hedge, let's just get rid of it.
Makes sense. Richard and Alice, they had their videos on, so I could see their hands. But if others want to do the same, either turn on your video or do just flag your hand on at the bottom of the screen. In the meantime, I have one more question for Alex. And Alex, we talked about how certain asset classes or families of asset classes can fulfill multiple roles in a portfolio. And I know recently you wrote a blog on private markets, and I really liked it. It's a little plug for your work that can be seen on LinkedIn and various other places, but and on our website. But it was really nice, short and sharp on how private markets work for pension schemes. Are you able to maybe comment, is there still a case for it? What do they do? And how do you view someone maybe considering it for the first time or looking to expand into that space?
Thanks, Sasha. So I don't have any football analogies like Dave at this point, but in terms of a one-liner for private markets, and at the risk of making a massive generalization here, I'd say that probably now is not a bad time. And of course it's very scheme specific, but kind of in the decade that has passed since the global financial crisis, like Dave has mentioned, we've seen kind of the majority of pension schemes focusing on growth and trying to plug the deficits that had ballooned following years of monetary stimulus. And there are some schemes out there that still require that growth, and that is still their focus. And for those schemes, private markets can definitely help. And what we've been seeing is that prices are depressed, and we think will continue to be depressed, and we expect that this will lead to opportunities, including in secondary investments where exposure has already been built up. And of course, there are schemes that are no longer focusing on growth, so to speak, but have kind of moved what they're looking for towards the midfield that Dave spoke about, and are focused a little bit more on income. For those schemes, again, we still believe that there are solutions out there within the private market sphere that can offer stable income in excess of what you can obtain in listed credit markets. That's of course if you're willing to accept the kind of 5 to 7 year time frame that some of those investments come with. But then again, what you get for that is access to an attractive yield as well, which could help to cover scheme running costs in the meantime. And I've got one final example that I will just share on my screen now for you all to see. And this is from Twain, who are an industry kind of expert in the alternatives area. And they have actually increased their return expectations by 5% for private equity funds that are launching in 2019. And this has just been an increase of 5%, I think, that they made in April versus their previous forecasts at the beginning of the year. One caveat to this that I would add is that not only have they raised the kind of overall return expectation, but they've also raised the expected dispersion that they expect between managers quite significantly. So that's the size of the bars, kind of the box in the box and whiskers plot there. And these are levels that we certainly haven't seen in the past decade. So I think I would use that as a one point of caution, and to kind of link back to what we said right at the beginning, around how we think that taking care in how you diversify, not just kind of across asset classes, but also within asset classes, is fairly important going forward.
Thank you very much, Alex. We've covered, I feel like we've covered a lot today, and 55 minutes have gone really fast. Thank you for everybody's questions. Just before we wrap up, I will share another screen with you. And this is just to make sure that hopefully everyone can see that.
Yeah, we can see it.
Good, thank you. So just a disclaimer for some of the slides we used during the presentation. I think I need to hold it for a certain number of seconds. And last time I counted down a bit too fast. But any further questions, you can find our contact details, at least mine, on our website, or definitely, I'm sure the team from PLSA can supply them. But we probably have time for maybe one more question. If not, maybe we've covered a lot. Okay, I will pass it over then to Rachel. And again, thank you everyone for your time, and stay safe.
Thank you, Sasha, Dave, and Alex. Lot to think about. Lots to think about there. We talked about interest rates, inflation, volatility, the direction the current scenario may take with these, and importantly, what pension funds can make of this information relative to their needs. So thank you very much for that. A big thank you to all of you who are watching. It was nice to see more faces on today's broadcast. And thanks to Sasha, Alex, and David and their colleagues at Russell for helping put this together today. And we hope to see all of you again soon. Bye for now.